Hello, my name is Rob Poterucha and I'm a tax supervisor here at McGowan, Hearst, Clark & Smith. Today's topic of discussion is fixed assets and the changes resulting from the Tax Cuts and Jobs Act that was passed in December of 2017. First, I want to define what fixed assets are. Fixed assets generally are tangible assets that are used in a trade or business. There can be some intangible assets, one example of which is computer software that would kind of get lumped in with fixed assets. The next question, since we've defined what fixed assets are, is how the cost of a fixed asset is recovered on a tax return. Normally when we think of depreciation, we think of the reduction in value of something. So you buy a car off the lot. The minute you drive off that lot, the car has depreciated in value. That's the first definition of depreciation. However, for tax, we have a different definition of depreciation. It's basically the cost recovery of an asset over its useful life. Useful life just kind of depends on the asset. It can be 3, 5, 7, 15, 27 and a half, 39 years. There's a lot of different lengths of time that we can depreciate an asset over. Since it's the tax code, we know that there's some complexity associated with depreciation. There's basically 3 ways you can depreciate a various asset. The first is you can depreciate it over its useful life, just like I mentioned above. So if you purchase a vehicle, it's a 5-year asset, you depreciate that over 5 years, and there's always various rules, especially with vehicles, but generally you can depreciate a vehicle over 5 years. And then the next 2 options allow you to depreciate the cost of an asset in the year you place it in service. The first one's called Section 179 expensing, and the second one is bonus depreciation. There are various rules to why you would choose Section 179 or bonus depreciation, but generally they allow you to deduct the entire cost of an asset in the year that you place it in service. One example we see here in Iowa especially relates to farming activities. So maybe a farmer will do a projection in November, December, see that they're having a really good year, and they may not want to pay the government as much money as they want to. So what they do is they buy a tractor, a combine, something like that in November, December, place that in service before the end of the year, and then they deduct the entire cost of that asset in that year that they place it in service, which reduces their tax liability. So that's a common example we see in Iowa, but it applies to all businesses, and that's one way you can reduce your tax liability towards the end of the year by doing a projection. Please feel free to reach out to us if you have any questions about fixed assets and recovering the cost of your fixed assets, whether you do it in the year you purchase it or you spread it out over its useful life. We'd be happy to help you. Also, please subscribe and like our YouTube channel. Please share it as well. We would greatly appreciate that, and we'll see you next time.